Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our webinar entitled Real Estate Investing in Your Self-Directed IRA. Before we get started, I just need to cover a bit of information about STC. We are a retirement plan administrator only, so we do not provide legal, tax, or investment advice. Also, we don't represent or sell securities or investments of any kind. We're not a registered investment advisor, and we don't represent or endorse any particular investment opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts, the benefits of self-directing, and the guidelines that need to be followed in all retirement account investing. I'm going to tell you some detailed information about STC, and then we're going to focus on real estate investing, choosing and funding an investment, purchasing real estate, talk a little bit about non-recourse loans, UBIT, UDFI, and then I'll open the floor for your questions. So first, to get started, I do want to define what we mean when we use the term self-directed retirement plan. We are talking about a plan that you hold with a company that permits you to choose any allowable type of asset, anything that is permitted by law. So that would include what some consider non-traditional assets like real estate. Self-direction also means that you are going to manage your retirement plan's investments. You're going to make the decisions related to the investments you hold in your account, so you have more control over those investments. Now, there are a number of different types of retirement plans. A traditional IRA, individual retirement account, and a Roth IRA are similar in that they have the same annual maximum contribution allowances. For 2022, you can contribute from your earned income $6,000 of your earned income into one of these accounts. If you are 50 years or older, you can contribute an additional $1,000 for a maximum of $7,000. Now, the big difference between these two plans is that contributions made to a Roth IRA are made post-tax. So that's a little different. That means that you pay taxes on the money that you're contributing. However, when you begin taking qualified distributions, once you reach retirement age and the account has been open for 60 months, 5 years, then those distributions are not included in your taxable income. So what that means is that the earnings on the money that you invest in a Roth account are virtually earned tax-free if you take them as qualified distributions. Unlike a traditional IRA, whose contributions are pre-tax, you make the contribution into the traditional IRA, and that amount is deducted from your taxable income in that year. And you don't begin paying taxes on distributions from the traditional IRA until you start taking them. So that's a big difference between traditional and Roth IRA accounts. A SEP is a simplified employee pension plan. It is often used by small business owners. It permits an employer and an employee contribution. Sole proprietors can also use that plan, as they may be both employer and employee. It does give you larger contribution allowances. For 2022, that amount is $61,000 from the earnings that the SEP business is on. A Simple is a savings incentive match plan. This is sometimes used by sole proprietors, sometimes partnerships. I've heard of using this type of plan. It also allows larger contributions than a traditional IRA account. For 2022, those are $14,000. Plus, if you're older than 50, you could add on. And now I'm bringing onto your slide 4 plans labeled former employer. A 401k is a for-profit company plan. 403b, often used by nonprofits or charitable organizations. TXSA, thrift tax sheltered annuity, TSP thrift savings plan. If you formerly worked for an employer and participated in one of these types of plans, then you can move the money out of that plan into a plan that you currently qualify for, and then you could self-direct those monies. A newer type of plan is the solo 401k plan. It does also have employer and employee contribution allowances. This is for individuals who are sole proprietors, who are in business for themselves, basically by themselves. Permits very limited employees. A spouse could be working in the business with you, but very, very limited otherwise employees. But it does give a sole proprietor an opportunity to save for retirement from the business earnings that the plan is on, as both employer and employee. It does have a Roth provision, so it does permit contributions Roth that are post-tax and then earned tax-free. And it does also have a loan provision that is also often beneficial to small business owners. So if you are interested in more information about a solo 401k plan, please do let me know. I'll have my email address at the end of the presentation, and I'd be happy to talk with you and give you some more information about that. So these types of plans can be self-directed if you choose an organization that permits self-direction. Now, why would you want to self-direct? Well, one of the biggest reasons is that you can truly diversify into all permissible types of assets. So you can include things that might be considered non-traditional, like real estate. You can own mortgages. You can make loans from your retirement funds. You can invest in private businesses. So you can diversify into different types of asset classes. You're not tied up with strictly stocks and bonds. In addition, you choose and you control the investments and the transactions. You can increase your buying power by using leverage. And what I mean by that is if you want to invest in real estate, your retirement account can take out a loan to purchase real estate. And we'll talk more about that on a future slide. But it does permit you to use other people's money. You don't have to fully fund the investment with your retirement fund. And because of all of these things, you may be able to experience a higher return on your retirement investment. Now, there are guidelines for self-directing, and these rules apply to whether you're self-directing or not. They apply to retirement accounts. There are administrative requirements that must be fulfilled. An annual valuation of your account must be made and an annual report submitted to the IRS, the Form 5498. Books and records, detailed records of all of the investments and all of the transactions must be maintained. Depending on what you own and where you own it, state filings may be necessary. And in some more rare instances, tax returns could come into play. Now, STC is a full-service self-directed retirement account administrator. So we will fulfill these administrative requirements for you. With one exception on this page, we are not permitted to prepare a tax return for your retirement account. But what we will do is give you, your tax preparer, all the necessary documentation so that if that does come into play, you will be able to get that prepared for your plan. Now, in addition to those administrative requirements, there are some prohibitions with retirement account investing, not just self-directed, but all retirement accounts. There are some assets that are prohibited. Number one, life insurance contracts, with one exception. If you have a solo 401k plan, a life insurance contract is a permissible investment. Other prohibited assets in your retirement plan are collectibles, rugs, works of art, stamp collections, coin collections. Now, this does not include precious metal investing. There are certain precious metals that are permitted as retirement account assets. If you are interested in what those specifically are, I can also give you some information about that. STC does hold precious metal investments for our clients. So if that's something you're interested in, we can help you with that. There are also some transactions that are prohibited. Now, your retirement account is given some tax-deferred benefits. You're not taxed on the earnings in your retirement account as they're earned, but when you take distributions at retirement age. So your retirement account is for the express purpose of benefiting you when you retire. So the transactions that you engage in do need to be for the benefit of the plan, and they are prohibited if they are not for the exclusive benefit of the plan. You cannot borrow money from your retirement plan. You can also cannot pledge your plan assets to secure a personal loan. I have heard from some folks that personal loan application might ask for their retirement account information, and that's not a problem as long as it's not security or collateral for that loan. That is not permitted. You also cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. Now, I did tell you that your plan could get a loan to purchase real estate, and it can, but it must not utilize your personal credit or guarantee. In other words, it has to be a certain type of loan, a non-recourse loan, and I'll talk more about that on a future slide, so hang in here with me. You can also not benefit any disqualified persons. So let's take a look at who disqualified persons are. And you'll see the first person I put on the slide is you. You and your retirement plan are separate entities. You cannot do a direct transaction with your retirement plan. So let me give you an example. Let's say you own a vacation rental property at the Outer Banks. Your retirement plan cannot purchase it from you. That would be a disqualified person, prohibited transaction. And if you are married, this would also include your spouse. And there are additional family members who are disqualified persons. Your ascendants, so that would be your parents, your grandparents, your great-grandparents on up the line. And your descendants, so that's your children, your grandchildren, your great-grandchildren on down the line, are all disqualified persons. So if your father owned that vacation property, your retirement account could not purchase it from him. If your daughter owned it, your retirement account could not purchase it from her. However, lateral family members are not disqualified persons to your retirement account. So lateral family members would be brothers and sisters, aunts and uncles, nieces and nephews, cousins. None of those are ascendants or descendants. So they are not disqualified. So if your brother owned that property or your aunt owned that property, your retirement account could purchase it from them or sell to them, either way. So just some things to keep in mind there. There are also two entities that are disqualified persons to your retirement account. Any company, doesn't matter how it's organized, LLC, S Corp, whatever, if you are a majority shareholder. Or any company if you're an officer, a director, or a highly compensated employee. Both of those entities are disqualified persons to your retirement account. So I will often talk to real estate investors who run their real estate investing business, maybe through an S Corp or an LLC. If they are a majority shareholder in that corporation, then that corporation cannot do any direct business with their retirement account. So let's say, for instance, their real estate investing business is an LLC. They own 100% of it, and it owns that vacation rental property in the Outer Banks. Their retirement account cannot purchase it from them or could not sell a property to that entity. So just some things to keep in mind when you're thinking about transactions that you might be interested in. Now, I will say that STC, as a full service administrator, will help you with these things. We'll help you look at your transactions and make sure that they're viable, that they're in compliance with the rules. So you don't have to be an expert. This is just sort of helping you think through initially when you're looking at investments. So STC's full service approach includes a setup of your retirement account LLC structure. We do use this structure for all of our clients, and I'm going to explain why we use that on the next slide. We also have CPAs and attorneys available to answer your technical questions about your transactions. We have a wonderful client services department that offers unlimited guidance on transaction compliance. We handle all that administrative back office support, all the records, the valuation, the reporting to the IRS. We'll take care of that for you. We will maintain financial statements for this LLC that we set up, so you can be running your retirement account like a business. You'll see balance sheet, an income statement, statement of cash flow, so you can see what's happening in detail in your retirement account. We will supervise that regulatory reporting and oversee that annual valuation. So basically, our goal is to provide you all of the administrative support and information about compliance, your transaction compliance, so that you can spend your time finding the best investments for your retirement account. Now, I want to talk a little bit more about this LLC structure that we use, and we do this for each client's account. We actually set up an LLC that becomes the investing entity for your retirement account. And we do this for a number of reasons. One of them is it offers you great flexibility in structuring complex transactions. Let's say you decide you want to co-partner with another source and co-own an investment, another source of funds. You can do that with your LLC as long as it's structured properly. Let's say you also want to get a loan and you own a real estate, piece of real estate co-owned with someone else. So these complex types of transactions are better suited to a structure like this that gives you a lot of flexibility. It does provide you an additional layer of asset protection. It is an LLC, albeit a very specialized one. It is, it's not a generic business LLC. It is actually the operating agreement, the articles of incorporation are written so that it owns a retirement account. It is a very specialized LLC that we set up for your account. One of the, maybe one of the biggest benefits that when I'm talking to people is that they have checkbook control over their retirement account funds. This means that you have an immediate response to investment opportunities. You can move very quickly. So you can send the documentation to our client services department. We will review that and look at everything. If everything is in order and in line, we can same day or next business day fund that transaction for you. But you'll notice I have checkbook control in quotes, and that is because we do not give our clients the checkbook for their account. And we really do that for your protection. Most clients don't know all the rules and regulations that relate to retirement account investing and could potentially unknowingly engage in a prohibited transaction. And the penalties can be very severe for doing that, up to forfeiture of your retirement account and it immediately becoming a taxable investment to you. So we offer you experts to look over your transactions, make sure that they are in compliance with the IRS rules, and then we can same day or next business day fund that transaction for you. So it's protected checkbook control. This LLC structure also simplifies asset titling. For example, if you decide you want to purchase real estate in your retirement account, you can actually go to the closing on behalf of your LLC retirement account, and you as the co-investment manager of this LLC, you can sign the documents, closing documents. You don't have to send them to our office where we review them and somebody there signs off on them. So it does simplify asset titling, especially in real estate. It makes it much more straightforward for you. It does also ease pooling or partnering with other sources of funds. So you do not have to wholly fund the investment. You could partner with, say, some of your personal investment money. You can do that at the inception of the transaction. You could partner with maybe an otherwise disqualified person, say your spouse's retirement account. Your retirement account, your spouse's retirement account could partner at the inception of the purchase transaction. That would be a viable transaction. So we can help you with those kinds of complex things, transactions, and the LLC structure makes that more straightforward. Now, in choosing an investment, you have a lot of options open to you with a self-directed account. And I've just brought out onto your screen a number of real estate transactions, investments that you could engage in. Single or multifamily homes, vacation property, raw land, building lots, commercial buildings, real estate syndications, tax liens, all of those are permissible real estate types of transactions. You could also invest in mortgages, loans, private business investments, operating businesses, precious metals. You can invest in the Forex market, foreign currency, options, futures, and also stocks, bonds, and mutual funds. So you have a wide range of different types of assets so you can diversify your retirement portfolio if you're interested in doing that. Now, while I am here, I will make one comment about real estate purchasing. If you might happen to be a rehabber and a flipper, purchasing property, rehabbing, and then selling it immediately, that could be looked at by the IRS as a business within your retirement account, and that could potentially be subject to UBIT, unrelated business income tax, which I'm going to talk about on a future slide. So our approach as an administrator for your account would be to suggest that you stay on the conservative side of that and maybe do 2 to 3 transactions a year if you're doing that kind of business. Now, we do have some clients who do more than that. They've gotten counsel from their accountant, and so they're doing more than that. But that is something to keep in mind because I often have real estate investors who are interested in doing multiple real estate transactions in a given year in their retirement account. So you want to keep that in mind, and you can talk with our client services department about that, and they can help give you some direction and guidance on how you might want to go about your investing. Now, let's talk specifically about investing your funds as an STC client. This is an optional step, but I highly recommend it, and that is to request a review of your transaction and its structure in advance of actually closing or purchasing the asset. This way, if there is anything that's questionable, those questions can be answered and taken care of before you're going to closing or the actual purchase. Then you would complete a request to transfer funds form. You would send that to our client services department. You could send it by email or fax, or you could mail it to us if you wanted to. And our client services department will review that transaction and all of the supporting documents. And then if that is a viable transaction and they don't have any questions about it, they will process the transfer request. The funds will be sent from the LLC bank account to the seller, and then your retirement account will own that asset. So now we're going to talk specifically about purchasing real estate. So as the owner of the retirement account, it is your responsibility to locate the property and make an offer on the property. Now, the offer must be in the name of the buyer. So if we're talking about your retirement account here, it will need to be in the name of your IRA LLC. And that has to be the exact name that's on the offer, the name of your IRA LLC. Now, if you are, I will add this, if you are seeking to co-own this asset with someone else, maybe personal funds, then both names would need to be on the offer. So that would be maybe your personal name, Mary Smith, and then your IRA LLC, Sunset Investments LLC. You would have both of those names on the offer if you are going to co-own with personal funds. Now, an escrow deposit is often needed, necessary, and so what we would need, our client services department would need, is a copy of the contract that shows the IRA LLC as the buyer and that completed request to transfer funds form. That's an FTC form. And if you're going to closing, we will also need a copy of the estimated HUD or settlement statement showing the IRA LLC as the buyer, and then that completed request to transfer funds form. And we ask that we have that at least one business day before closing by 2 p.m. That is our bank cutoff, 2 o'clock p.m. Eastern time. So we would need it at least by then, and if you could give us some additional time, that would be great, because if there's any question about any piece of the documentation, our client services department is going to want to discuss that with you. So I always recommend giving them extra time so that if there's any question, you'll still be able to go to closing on time if you need to make some change in something. Now, guaranteed funds, typically the disbursement of the funds for the purchase of real estate does need to be guaranteed funds. So usually you're requesting a wire transfer, could be a bank's official check. Nowadays, I'm hearing more and more that they're not even accepting those just because of the fraud that can be prevalent with those, but however you need those funds, we can get that for you. And one of the benefits of our IRA LLC, as I said earlier, is that you can actually go to the settlement table and sign all those closing documents. So our client services department will discuss the transaction with you to make sure that you're not dealing with any disqualified parties or using any prohibited funds, and that you're using the proper name and titling. However, we don't need to approve and sign the documents, and that is required by many custodians when this LLC structure is not used. So we don't need to approve and sign. We will discuss these other things beforehand, and then you can go to closing. You would send us a copy of the closing documents, and you can keep the original. So we would have records of those for your account. Now, you do have the option to use borrowed funds, as I mentioned earlier. However, it must be in the form of a non-recourse loan, and UBIT will come into play if you do that, and I will explain how that's calculated and how you want to figure that into your investment thinking before you make an investment if you choose to do that. If you are partnering with yourself personally, let's say you have some personal money and you have retirement account money, and the two pots of money are investing in this piece of real estate, then you cannot personally guarantee a loan for your portion. So if your IRA is involved, then only the property can be collateral for the loan. So something else you would want to discuss with our client services department. If the IRA LLC is the borrower, the IRA LLC makes the loan payment. If the loan is for the personal portion, then the payments would be made personally. But either way, if you use a loan, UBIT is going to come into play, and we'll discuss that, and I'll show you a calculation actually. Now, back to this whole idea of partnering with someone. You can partner with anyone at inception of the transaction. However, if you were partnering with an otherwise disqualified person, so say personal money or your spouse's personal money, your spouse's retirement account, your father, your daughter, any of those disqualified parties, then the percentage ownership of this property can never change. So what I mean, just to think through that, let's say you purchase a rental property with personal money. You own it 50-50 personally and 50% your retirement account. So those are the percentages. They cannot change. The property needs a new roof. You must pay for that new roof 50% personally and 50% from your retirement account. Otherwise, that ownership percentage would change. One of those parties would have more invested than their original 50%. So that's what I mean when I say the ownership percentage can never change. You can do this type of investment, but you need to keep that in mind. All property expenses are paid pro rata based on ownership, and all property revenues are distributed pro rata based on ownership. Now, some clients prefer to set up a sub-LLC to own the property, and you can do that. The only thing is none of the rules change. All the rules relating to retirement accounts must still be followed. So in this scenario, if you wanted to set up a sub-LLC to own a particular property, we would want to see the operating agreement stating clearly who the owners of that sub-LLC are and the amount that they're investing and their percentage ownership. And what we would expect to see is that the percentages of ownership match up with the dollar amounts invested. And it's actually a requirement if the owners of the sub-LLC are otherwise disqualified parties. However, if one of those parties is serving another role, for example, they're going to be a general contractor, the property is going to be rehabbed, and they are not a disqualified party, then they could get a larger percentage of the profits for that role. But that is never permitted if any of the parties are disqualified. So kind of keep that in mind when you're thinking about, you can do pretty complex transactions, but you will want to run those by our client services department so that we can make sure that you stay within compliance of the rules. And you want to keep in mind that even with a sub-LLC, all the same IRS and ERISA guidelines apply. So you still can't guarantee any loans personally. The loans have to be non-recourse. UBIT is still going to apply. Disqualified parties cannot be doing any rehab work or repairs. So like your mother couldn't be a tenant. Your dad couldn't be fixing the roof. So those things, the rules still apply, even if you're using a sub-LLC. Disqualified persons cannot do rehab or repair. So that means I should probably make that clear. You are a disqualified person to your retirement account. So if you are purchasing a property and rehabbing it, you will have to hire somebody who is not a disqualified person to do that rehab and repair. You cannot do that personally. Now, partnering with others, I've mentioned this before, but I will reiterate it. You can partner with yourself, with your spouse, with family members who might otherwise be disqualified, as long as you do that at the inception of the purchase transaction. So when you are going to purchase from the seller, each of you is purchasing your percentage from the seller. So each of you has the transaction with the seller and not with each other. You can partner with colleagues, LLCs. They can be S Corps, LLCs, investment syndications. So all of those are valid partners so that you don't have to wholly own the investment yourself. This is a schematic just to kind of show you how the structure would work. On the upper left, you see your current custodian. when you decide you want to work with FTC, you would fill out some documents that would direct your current custodian to transfer or roll over your monies to our self-directed custodian. We will be setting up that LLC in the state of your choice while that is happening, while the monies are being moved. Once the LLC is completely set up and the monies have been received by our custodian, then the money will move to a bank account that your LLC has access to, and the membership interests of the LLC will be held by the custodian. So then you're ready for investing. And in this example, you can see that your investment number 1 is a tax lien investment. Investment number 2, you purchase property for rehab and rental. And investment number 3, your retirement plan is not the sole owner. You are one of 4 owners. You pooled funds with others to purchase a small retail center. So your father is one of the owners, your daughter is one of the owners, some of your personal money, and your retirement account. So there are 4 owners in this investment. And that is allowable if you all co-invest at the inception of the purchase transaction. And again, our client services department will help you understand how to accommodate that. That will make that a viable transaction. Now let's talk a little bit about non-recourse loans, because I know I have a lot of real estate investors who are interested in this topic. First, what is a non-recourse loan? Well, it is simply a loan that means the security instruments, the notes, the mortgages allow no recourse against the individual account holder or the balance in your retirement account. In the event of default or foreclosure, the only source of repayment the lender has is the property itself. There is no other recourse. So there's no income or employment verification. It's much like a business loan. Your retirement account doesn't have a job, so there's no income, no employment verification. Some general industry standards, required documentation. They're going to likely want to see a loan application, purchase and sale contract for the property. They'll want to see an IRA statement or whatever your retirement account is, a statement of your account. They'll want an appraisal of the property. If it's rental, they'll want to see a rent roll. Loan guidelines, generally maximum loan to value is 70%. So unlike a personally guaranteed loan, you'll have to put down a significantly larger down payment, 30% plus. Maximum term, 20 to 30 years. Some non-recourse lenders do ARMs, adjustable rate mortgages, 3-1, 5-1, 7-1, I've heard of. They will also be looking, if it's like a rental property, they will also be looking for an income to expense ratio of 1.25 or more. And they will also likely ask you to hold 3 to 6 months of reserve cash held in your retirement account. So let me just explain a little bit about that. Because your retirement account owns this property, there will be things like property taxes, maybe insurance, possible repairs, maintenance. Those expenses are expenses of your retirement account. Now, you are only permitted to make contributions into your retirement account from your earned income based up to a maximum each year. And so the lender will want to make sure that if you have insurance, property tax, potential repairs, possible expenses coming due to this property, that your retirement has those funds in it. Your retirement account has those monies because you may not be permitted to make an additional contribution. So often they will have a reserve requirement. They want you to hold a certain amount of cash in your retirement account for the property to be eligible for the loan. Eligible and ineligible properties. Eligible single-family homes, certain condos, 2 to 4 plexes, multifamily homes like 5+ small apartment buildings, retail, office, warehouse, all of those are eligible properties for non-recourse loans. Things that are ineligible are mobile homes, timeshares, condo, hotels, some certain restaurants, so you'll need to check with your lender, residences with 5 or more acres, and farms are usually ineligible. So if you are interested in more details about non-recourse lending, I do have a previously recorded webinar on our website that you may find helpful. Now, I also want to talk about UBIT, Unrelated Business Income Tax, and a subset of that, which is UDFI, Unrelated Debt Financed Income. So this applies to any income that is generated from an asset that's purchased using financing in your retirement account. The IRS has decided that this qualifies as a taxable event. So UDFI is, it applies to the income that's generated from that asset. It is based on the net income of the property, not the revenue that's generated. So it's revenue minus expenses, net income. And the first $1,000 of that net income is exempt from taxation. And the tax is only on the percent of the property or the earnings that are related to the ratio of debt. So the percentage of taxable income is based on the ratio of debt. So let's say you purchased a property for $200,000. You had $100,000 down and the finance the remaining $100,000. So that means 50% of the net income would be taxed because 50% of the property is debt financed. And after a few years, if you reduce that debt to say $80,000, then only 40% of the net income would be taxed. So that is a calculation that would be done on a yearly basis to determine if you had a tax consequence. Now, when the time comes to sell, if that loan has not been fully paid off for a full 12 months, then a portion of the proceeds of the sale is also subject to UDFI. So that would be another calculation you and your accountant would want to look into. Now, I will mention here just one caveat. If your retirement account is a solo 401k plan, then UDFI does not apply to a debt, a leveraged real estate asset in your solo 401k plan. So that is another benefit of a solo 401k. So let's just walk through an example to help you understand this, because I know sometimes taxes is like, oh, it's over my head. So we'll just do a real simple example here. And we'll just say it was that rental property I just spoke about that was $200,000. You had $100,000 you invested and then a $100,000 loan. So it's 50% debt finance. Now, your annual net rental income is $12,000, making it easy to do the calculation here. So $1,000 a month, and that's net. So that's the revenue less the expenses, net income. Now, the income that would be subject to UDFI in this year would be $5,000. And how did I calculate that? Because it's 50% debt financed, I took $12,000 times 50%. That gives me $6,000. And then I told you that the first $1,000 was tax exempt. So I subtracted $1,000. So the amount of your $12,000 net rental income that's subject to UDFI is $5,000. Now, the 2022 trust tax rate, that's the rate that UDFI and UBIT are taxed at, is a graduated rate from 10% to 37%. And in this example, the calculation would bring you to taxes of $815. So let's have a look then. Your net income on this 50% debt finance property after UDFI is $11,185. So if you can do this kind of calculation when you're considering whether or not you want to debt finance a property, maybe you couldn't afford the property without getting a loan. And keep in mind that this is net income, so the expenses of this loan are being deducted from your net income. So maybe when you look at this bottom line, you see, well, for $815, yeah, I'm willing to, do a loan because I'm generating enough income after taxes. So this might be how you and your accountant could evaluate a transaction and how what the tax consequences might be. Now, it is reported on to the IRS on a Form 990-T. Again, it's taxable at that trust tax rate, and we recommend that you discuss the tax situation with your tax advisor. I will also say that the taxes must be paid from the monies in the retirement account. Now, obviously, you had $12,000 in the account. So you have the money there to pay the $815 in taxes, but it does need to be paid from your retirement account. All right, so that is the information that I wanted to cover in this webinar. I'm going to open the floor for your questions now. You should have a box on your menu line that says questions. And if you would please open that box up, and I'm going to open it on my end, and write in any questions. I did get some in advance of the webinar, so let me pull those out as well. And while I wait for you to type some questions, please do note how you can get in touch with us. Our website is stcira.com. We have a great deal of information there. We also have some testimonials from clients who've done some interesting transactions that you might find interesting. So you might have a look at those. Our corporate office number is there for you, and you can also contact me directly at my email with any questions, or if you're interested in some paperwork, we can get that out to you. So give me a moment. I'm going to open up my question box here and see what I have. Okay. Okay, somebody has asked, what is a Roth solo 401k? That is really actually a bit of a misnomer. There is no separate Roth solo 401k plan. Rather, you set up your solo 401k plan with a Roth amendment provision. And when that amendment is in place in your plan documents, then the employee's contribution can be designated as Roth funds. So the employee, you would pay taxes on the amount of that contribution, but then as those Roth monies earn over time, just like in a Roth IRA, they would be earning tax-free, not just tax-deferred, but tax-free. Can I contribute to both a Roth IRA and the Roth provision of a solo 401k? That's a very good question. I don't get asked that often, but the answer is yes, you can. That's great news for individuals who qualify for both a Roth IRA and a solo 401k, because you have two plans that you can make Roth contributions to. So yes, if you need more information about solo 401ks, please do let me know. You do need to have a solo 401k plan set up by December 31st of the year you want to make a contribution. So do keep that in mind. If you are interested for making a 2022 contribution from your business, don't delay. You want to get that plan set up before December 31st of this year. Okay. Once my account setup is complete, what does STC require from me to purchase an investment, and what is the turnaround time? Basically back to that form that I mentioned, we need one of our forms. That's a request to transfer funds form. And then we'll, depending on the type of investment, we'll need backup documentation. So if it's real estate, we'll need a HUD form, a promissory note. We'll need something showing us what the investment is. And then as long as the paperwork is in order and we have it by our bank's 2 p.m. cutoff time, we can generate a same-day wire transfer to the seller and purchase that investment for your account. If it does come in after 2 p.m., then it would be next business day. So you do want to keep that in mind. If you have a rental property in your account, who does the renter send their rent check to? That really depends on if you're using a property manager or not. And I will say we do highly recommend you use a property manager because that maintains that arm's length distance between you, the owner of the retirement account, and the investment that's held by your retirement account. So typically a property manager would collect the rent, so the checks would be made payable to them, and then they would deduct their fee for the management, and then they would forward the remainder to us in the name of your IRA LLC, and then we would deposit that into your account. Now, if you're not using a property manager, then the checks do need to be made payable to your IRA LLC. They cannot be made payable to you personally. That would violate the disqualified person rule and be a prohibited transaction. So they do need to be made payable to your IRA LLC and mailed to our office. I mean, they can mail it to you, but then you're going to have to turn around and send it to us so we can deposit it into your LLC account. And either way, whenever we get funds for your account, we will email you that day when the funds have been received and posted to your account. Okay, a couple more. If I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes. Yes, you can. You can open a brokerage account with any company that you choose. The account must be opened, though, as a business account in the name of your IRA LLC. And we do request that you send us copies of the monthly statements for that account. We need to ensure that there are not any deposits or withdrawals from that account by you personally, because it's a retirement account asset, so they do need to go through your retirement account. If you want to put more money into that account, then you need to be eligible to make a contribution from your earnings into the retirement account that we can then invest in that stock brokerage account for you. If you want to sell something and make a withdrawal, you would sell. The monies would go into your IRA LLC account, and then we would give you a distribution, which would be a retirement account distribution. So you do need to be aware of how the money needs to flow if you do have that type of account. Okay, I have time for one more. Well, I'll do two more questions. Does STC choose the terms of my loans? No, actually we don't. This is true self-direction. You're going to choose the terms of your loans if you are making a loan to someone from your retirement account. What we will do is we will make you aware if any of your terms are items that might raise a red flag in an IRS audit. For example, let's say you're loaning funds for 5 years at 1% interest rate. You need to keep in mind that the goal of your IRA is to increase in value, and the IRS would wonder why you made a loan at such a low rate when people can't get that kind of a rate from another type of lender. So we wouldn't tell you that you need to change it, but we would let you know that those types of terms could be placing your IRA at risk with the IRS. Okay, and this was a question I got also that I do want to cover. A traditional IRA requires the owner to begin withdrawals at age 72 now. So that was changed a couple of years ago. If one owns real estate in their account, is it required to sell it at some point in time? And the answer is no, you're not required to sell a property to take the required minimum distribution. You could take that RMD as property value. And what I mean by that is at the end of the year, you could have that property appraised and then you could retitle it partially in your personal ownership and your retirement account ownership and take your RMD as the value of that property, the portion that you now own personally. So you can do that. If a portion of the real estate is distributed like that, then if there's like any rental income, then that all has to be split up by this new percentage as well. So that is something to keep in mind. All right, well, thank you so much. If you have questions that come to mind after we close out the webinar, please do contact me directly or call our office. We would be happy to help you. If you're interested in getting started, we can get the paperwork to you and help you get that completed. So thank you so much. We do an educational webinar each month, so I hope that you will join me next month. Thank you so much. Good night.